Hi, Michael Glennon from Glennon Capital. I'm going to give you a quick update on franking. So that's both the franking that the portfolio is receiving from its investments, the franking account in Glennon Capital, and just allay some of the concerns that some investors have had recently in relation to what's going to be happening with their investment and our ability to continue paying out franking credits if the changes to franking credits that the Labor Party was suggesting come through. So first thing, the portfolio, we've told several people, and we've mentioned in our announcements that we've embarked on a very deliberate strategy to credits. That's been quite successful so far. We exited our position in 360 Capital with quite a significant dividend to the portfolio. So we paid $1 for the shares. We had 10% of the portfolio in 360 Capital, and it paid a 21-cent fully franked dividend, of which there was about 7 cents of franking attached to the vehicle. So that's allowed us to start towards accumulating a reasonable balance in franking credits. We've subsequently moved into tax-free, which is also paying a significant fully franked dividend. So those two transactions are part of that strategy we've got of accumulating franking credits aggressively to ensure that we've got sufficient franking to be able to frank our dividends. At the moment, the profit reserve is 16 cents, which means at the current rate of 4 cents of dividends a year, we can pay the next 4 years worth of dividends. We don't have enough franking to do that, but as I mentioned, we are working towards a position where we hope we would continue franking those credits. To allay people's concerns about what would happen if there was a change to superannuation funds being able to get back the differential between their tax rate and the tax that's being paid by the company. We would investigate transferring our listed investment company to either a listed investment trust or to a stapled security that is stapled to a trust, in which case a higher amount, a trust would pay out all of the income that's earned during a year as opposed to a percentage of it. So we would just move down that path. It'd probably be more beneficial to investors because there'd be no double taxation going on. So contrary to the government's aims, we would just shift the tax liability from the company at 30% to superannuation investors at 15%. So I actually don't think that would have any negative impact on Glennon Capital. We're aware of that, and we'd make moves to shift into play. So look, I'm happy with where we sit now. We've got ability to pay 16 cents of dividends in our profit reserve. We're accumulating franking credits in the investments in the portfolio, and we've thought about what would happen if there was a change to existing structure. So with that in mind, I think that you can all rest reasonably easy that the investment still makes sense from an income perspective, and we're still doing the same things in terms of generating capital growth for the portfolio. So I'm Michael Glennon, and thanks for watching.